You feel that? That subtle shift in the air? It's not just the economy cooling down, it's the sound of a door closing. For the last few years, we've been living in a bit of a tax fantasy land. Low rates, doubled standard deductions, the works. But come January 1st, 2026, the Tax Cuts and Jobs Act, the TCJA, sunsets. And if your portfolio is sitting there on autopilot, you are walking straight into a buzzsaw. Look, I'm not here to scare you. Panic is expensive. Preparation is profitable. Most people think 2026 just means taxes go up. That's the lazy take. The reality is an economic pincer movement. You have tax brackets reverting to higher levels on one side and persistent inflation eroding purchasing power on the other. So what actually happens? The 12% bracket? That snaps back to 15%. The 22%? It jumps to 25%. And that massive standard deduction you've been enjoying gets cut effectively in half for many families. But here is the killer, the hidden tax on your portfolio efficiency. Most of you have asset allocation down, stocks versus bonds, but almost nobody talks about asset location. This is your shield against 2026. Think about it. If you hold high-yield corporate bonds or REITs in a standard brokerage account when the rates jump, you are voluntarily handing over a bigger slice of that yield to the IRS every single year. It's a drag on your compound interest that you can't see until it's too late. The solution is reverse engineering your portfolio based on tax efficiency. We call this the silo strategy. Silo 1, tax-free. This is your Roth. Right now, we are in a historic conversion window. You have until the ball drops on 2025 to convert traditional IRA money to Roth at today's discounted tax rates. You pay the tax now, yes, it hurts, but you lock in tax-free growth forever. You are essentially betting that taxes will be higher in the future. Spoiler alert, they probably will be. Silo 2, tax deferred, your 401ks. Keep your heavy income-generating assets here. Let the interest compound without the tax drag and only pay the piper when you withdraw in retirement, hopefully when you can control your income bracket. Silo 3, taxable. This is for your low-turnover ETFs and municipal bonds, stuff that doesn't generate phantom income. But here is the economic twist. If we hit a recession in late 2025, asset prices might drop. That is actually your best friend. Why? Because tax loss harvesting becomes your superpower. You sell the losers to offset gains, and you convert your depressed assets to Roth while their value is low. You move more shares for the same tax bill. 2026 isn't the end of the world, it's just a new set of rules. The government changes the board game every few years. The winners are just the ones who read the rulebook before the dice are rolled. Don't wait for the news anchors to tell you taxes went up. Build the fortress now.